Every time you apply for a credit card, a car loan, an apartment, or even certain jobs in the United States, a silent decision is being made about you often in seconds. That decision is based on a simple 3-digit number that most people don't fully understand. Yet, it can cost or save you tens of thousands of dollars over your lifetime. Two people can earn the same income, live in the same city, and apply for the same loan. Yet one gets approved instantly with a low interest rate, while the other is rejected or charged more. The difference isn't luck, and it isn't income, it's their credit score. This number determines how risky lenders think you are, how much interest you pay, and how easily you can access financial opportunities. One late payment, one maxed out credit card, or one mistake you didn't even realize mattered can quietly push that number down and affect your financial future for years. And the worst part is that many Americans damage their credit not because they were irresponsible, but because no one ever explained how the system actually works. Welcome to Credit Score Lab, the channel where we break down the US credit system in clear, simple terms, so you can take control of your financial life instead of guessing your way through it. In this video, we're going to answer one of the most important questions in personal finance. What exactly is a credit score? And why does it matter so much in the United States? We'll explain what that 3-digit number really represents, who creates it, how it's calculated, and why lenders trust it more than your income or savings. Whether you're starting with no credit, trying to recover from bad credit, or aiming for a strong 700+ score, understanding this foundation is the first step. By the end of this video, you'll know how the credit system judges you, why small actions can make a big difference, and how to avoid the common mistakes that quietly destroy credit scores every day. The term credit score sounds technical, but at its core, it's simply a measure of trust. In the United States, a credit score is a 3-digit number that tells lenders how likely you are to repay borrowed money on time. This number usually ranges from 300 to 850, and the higher it is, the more trustworthy you appear to banks, credit card companies, landlords, and even some employers. Think of it as a financial reputation score. Just like a school report card summarizes a student's performance, your credit score summarizes your past behavior with credit. It doesn't measure how much money you make or how smart you are with money, it measures consistency. Have you paid your bills on time? Do you borrow responsibly? Do you manage debt without relying too heavily on it? Lenders don't know you personally, so instead of trusting promises, they trust patterns. Your credit score exists because lenders want a quick, standardized way to judge risk. Without it, every loan decision would take weeks of manual review. With it, decisions happen in seconds. This is why your credit score matters, even if you don't plan to borrow money right now. It influences interest rates, approvals, security deposits, and financial opportunities long before you realize it. Understanding this number is the first step to understanding how the US financial system sees you. Behind every credit score are companies quietly collecting and organizing your financial behavior. These companies are called credit bureaus, and in the United States, there are 3 major ones: Experian, Equifax, and TransUnion. Their job is to gather information from lenders like banks, credit card issuers, auto lenders, and mortgage companies. Every time you open an account, make a payment, miss a payment, or close an account, that activity is reported to one or more of these bureaus. The bureaus then store this information in what's called your credit report. Your credit report is not your credit score, it's the raw data. It includes details like account balances, payment history, credit limits, and public records such as bankruptcies. Because lenders don't always report to all 3 bureaus, the information on each report can be slightly different. That's why your credit score can vary depending on which bureau's data is being used. The bureaus themselves don't decide whether you're approved or rejected for credit. They simply collect information. Think of them as data warehouses. The real decision-making happens when scoring models analyze this data and turn it into a score lenders can use. When people check their credit score online, they often don't realize that not all credit scores are created equal. The 2 most common scoring models are FICO score and VantageScore. FICO is the most important one to understand because it's used by the majority of lenders in the United States. Created by the Fair Isaac Corporation, the FICO score has been around for decades and has multiple versions designed for different types of lending, such as credit cards, auto loans, and mortgages. VantageScore, on the other hand, was created jointly by the 3 credit bureaus as an alternative model. While it's commonly shown on free credit monitoring apps, it's not used as widely by lenders. This leads to a common mistake. People think they have excellent credit based on a free score they see online, only to be surprised when a lender pulls a different score. The key takeaway is that your real credit score depends on who is checking it and why. FICO scores generally matter more in real-world lending decisions, especially for large loans like mortgages. Understanding which score lenders actually use helps you avoid confusion and focus on what truly impacts approvals and interest rates. Your credit score isn't random, it's calculated using specific factors that measure how you handle credit over time. The most important factor is payment history, which makes up about 35% of your score. This tracks whether you pay your bills on time. Even one late payment can significantly hurt your score, especially if it's recent. The second most important factor is credit utilization, which accounts for about 30%. This looks at how much of your available credit you're using. Using too much of your credit limit signals financial stress, even if you pay on time. Length of credit history makes up about 15% and rewards long-term, stable accounts. This is why closing old accounts can sometimes hurt your score. Credit mix, about 10%, looks at whether you can handle different types of credit, such as cards and loans. Finally, new credit and inquiries account for the remaining 10%. Applying for too much credit in a short time can make you appear risky. Together, these factors create a picture of your financial behavior, not just today, but over years. Credit scores are often grouped into ranges, and each range tells lenders something different about you. Scores below 580 are generally considered poor and signal high risk. Borrowers in this range often face rejections or extremely high interest rates. Scores between 580 and 669 are considered fair, meaning lenders may approve you but with less favorable terms. A score between 670 and 739 is considered good and usually qualifies for decent rates and approvals. Scores from 740 to 799 are very good and unlock better terms, while scores above 800 are considered excellent and represent extremely low risk. Reaching higher ranges doesn't just improve approval, odds it directly affects how much money you pay over time. A difference of even 50 points can mean thousands of dollars in extra interest on a mortgage or auto loan. This is why lenders care so much about small score changes, and why improving your credit score is one of the most powerful financial moves you can make. Many people assume income is the most important factor in financial decisions, but in reality, credit score often matters more. A high income doesn't guarantee approval if your credit history shows missed payments or heavy debt usage. On the other hand, someone with a modest income but a strong credit score is often seen as reliable and low risk. Lenders care less about how much you earn and more about how you manage what you borrow. Your credit score answers questions income cannot. Do you pay consistently? Do you overextend yourself? Can you handle debt responsibly? This is why people with good credit get lower interest rates, higher limits, and better financial opportunities. Over time, good credit saves money, while bad credit quietly drains it through higher costs. Understanding this shift from income-focused thinking to credit-focused thinking is what allows people to work with the system instead of fighting it. Understanding what a credit score really is puts you ahead of most people, because once you know how the system works, it stops feeling confusing or unfair. Your credit score isn't about perfection, wealth, or luck. It's about patterns, consistency, and informed decisions over time. Every payment you make, every balance you carry, and every account you open sends a signal about how you manage credit, and those signals add up. The good news is that this system is predictable, and when something is predictable, it can be improved. No matter where your credit stands right now, whether you're just starting, rebuilding after mistakes, or trying to move from good to excellent, you have more control than you think. In the next videos on Credit Score Lab, we'll break down exactly how to build credit from scratch, how to fix common credit mistakes, and how to raise your score using proven, legal strategies that actually work in the United States. If this video helped you understand credit scores more clearly, make sure to subscribe so you don't miss those step-by-step guides. Like the video if you found it useful, and share it with someone who might be struggling to understand their credit. This is Credit Score Lab, where your credit gets smarter and your financial future gets stronger.